Hey, Coconut. So, yes, Reggie here. I'm taking a break, all that jazz. I know you know by now. But today, align with some of the content that's coming up. We're going to talk about CPF. We're going to talk about like investing with CPF money. We're going to talk about like reviewing various funds and all that different jazz, right? I felt like I need to bring up this topic, which is in the middle. Okay, so in podcast consumption, it tends to be that people will listen to the front few episodes and people will listen to the latest one. But things in the middle tends to get drowned out. So I'm gonna bring out this episode today for all of you, focusing on how to choose an index ETF. What are the core caveats when picking index ETFs, right? So this is episode 30 on this current feed, and I'm gonna bring it over again today to set the premise so that all of us can learn better and form the basis of a future discussion going forward. Essentially, index investing is very popular. It's been very popular because there's a lot of research at this point in time to show that active managers may not perform as well as just buying the whole market. But is this true? Is this gonna be going forward? I'm not sure. Historical returns do not determine the future, so let's see if that happens. But this episode will give you basics to understand index ETF and use these basics to then evaluate all these other theme funds and all these interesting things that are coming up. People are creating all these interesting ETFs and all these interesting structured products. And where do you start? You got to start by understanding the most vanilla of things, index ETF, okay, index funds. So yes, I hope you enjoy today's episode, and if you love the episode, please continue to share with your friends and also check out some of the other peripheral episodes around it, right? So episode 30 something to 40 something was the period where I had a lot of these kind of learnings as I go along because I ran out of stuff to talk about from my head. So I learned a lot of interesting things from 30 to about 40 plus. So all that content, check it out. Enjoy today. Take care. See you next week. I'll be back. Good day, guys. I know in your head, right, there's this one question that is boggling you. It's like, hey, why so many negative news, but the stock market still keep going up and up and up, Have we passed the bottom? Am I gonna lose this chance to acquire good companies? Haha, so all the FOMO is setting in, and a lot of my friends have been asking me all sorts of questions. How do I start? How do I invest? And in my head, it's like, bro, don't rush, right? If you're in a rush, chances are you will not do very well. But then my question is, okay, so if I don't want them to rush, how can I kind of give them some thoughts so that they can get some exposure to make some money without the risk of, kind of busting it? And I thought, okay, maybe we should really explore index ETFs, right? And I really want to share with you what I found, some of my thoughts, and today we're going to talk about the 3 pointers to look out for when investing in index ETFs. So good morning, everyone. I welcome you to another day with the Financial Coconut. In our podcast, we'll be debunking financial myths, discovering best financial practices, discussing financial strategies that fits our lives. You get it. Ultimately empowering us to create a life we love while managing our finances well. So today's topic, 3 pointers to look out for when investing in index ETFs. So yeah, good day guys. Happy to be chatting with you guys again and sharing with you some of my thoughts around, investing, around personal finance, and in general, I think, at this point in time, if you are considering investing, you are even in the discussion of investing, then you are in a pretty good space, honestly, right? That means your income is pretty stable, you have your savings, you've done all the groundwork that you need to do to be able to be at this point in time, even think about investing. But maybe there's one thing you've not really done yet, which is to really think of how to invest, to really go and learn over time, which is very understandable because, if you want to make all that money, you got to probably be spending a lot of time doing what you do, brush up on yourself, and get to where you are today. So you have all this surplus sitting around, and you always hear people saying, hey, how the market come down, I must buy, buy anything, also make money. Clearly that's not the case, and we went through that in the past few episodes. So do check out the past few episodes, some of the mass misconceptions that people have about investing in the stock market. And I want to put it out there that before all these lockdown, before all these RMO stay home notice and this market collapse, I was never, very interested in index investing. I was never a big proponent of, index funds, and all the ETFs that people talk about all over YouTube, everywhere. A lot of these personal finance professionals or personal finance gurus, whatever you call them, they keep talking about index investing. So I'm not a big fan of that before. It doesn't mean I'm a huge fan of it now. I'm just a lot clearer about what it does. Right. So ultimately, you got to realize that there are many tools to do all these different things. And investing has a lot of different strategies, right? And a lot of different tools out there. So over time, I slowly learned to appreciate different tools. I started out only picking stocks in the US. And then slowly I look into REITs in Singapore. And then now I'm looking into index investing. And the reason why I'm looking into it, the reason why I'm actually bothered to study it, it's because of you guys. Because a lot of you guys, after listening to the podcast, or some of my friends, they just came and asked, hey, how do I start? How do I start investing? What kind of stocks do I pick? And in my head, it's like, bro, you're just in a rush. It's virtually impossible to do it in such a short period of time. But then I want to give them another alternative, right? It's like, if realistically, you cannot do it, right? You're not able to pick stocks in a short period of time, at least not with some level of finesse and understanding. So then, if you want to be vested, given such a short period of time, definitely I feel index investing is one of those strategies that it works. Right. So what is index investing? Right. What is an index ETF? So essentially, index investing is trying to buy an index. So an index is essentially a measurement, right? So like the Dow Jones Industrial Index, that is a very common and popular index, right? That is the 30 biggest manufacturing companies in the US, right? The S&P 500 Standards and Poor 500 Index is the measurement of 500 of the best companies in the US. Supposedly, right? They all have their own measurement. That's up to them to decide. And then there's the Hang Seng Index, which is the top 50 companies in Hong Kong across 4 different sectors. And then famously, we have the Straits Times Index back at home, right, which measures 30 companies in the Singapore Stock Exchange. All of them are trying to do one thing. They're all trying to indicate the performance of the stock exchange. And while we'll not go deep into breaking down all the weightages and why these indexes track these companies, right? All those things you can go and geek it out yourself. It's not difficult to find. But by recognizing that all these indexes are trying to track the broad market movement, you realize that what is it trying to say is that if the market is doing well, the index will go up. If the market is not doing well, the index will come down. And that is the beauty of index investing, right? You don't actually need to, break your head and choose companies and, try to find the value and all those things. All those are great, right? They have their own way of doing things. It's just that it's within a short period of time. Realistically, I think it's quite challenging for anybody to chime in on that. And sometimes you just don't want to do it, right? I have some friends who, just want to focus on what they do. They don't want to spend all day trying to study the charts, trying to study the market, trying to study the fundamentals. So yeah, index has its position and it's pretty interesting. But the truth is you cannot actually buy an index. An index is just a measurement run by a company, whether it's Standards and Poor's, whether it's Straits Times, different companies, they have their own indicators to help people understand what's going on in the market because it tracks market movement essentially, right? But over time, there's a bunch of people that came out with this thing called an index ETF, also known as exchange traded funds. And these index ETFs aim to copy the movement of the indexes. Right, so you cannot buy the index because that is a measurement tool, but you can buy these index ETFs that are trying to copy the index movement such that you can get exposure to the market, meaning when the market grow, your portfolio can grow along together with the market. And yes, the first point I have for you when looking out to invest in an index ETF is that you definitely want to be a cheapo and go for low fees. So the idea is that in the broad market of ETFs, there are two kinds of generally there are two kinds of ETFs. One is what we are going to talk about, index ETFs, and the other one is what we call a sector ETF. It can be a particular sector, or it can be a particular country, particular region. That requires a bit more work, depending on what the fund is trying to do. I mean, it's essentially depends on the managers, right? Are they trying to do equal weighted? Are they going to try to do capex weighted? And all those things we can talk about in another podcast. But why I share with you this, right, is that you need to realize that in the index ETF, there's not much work to do, right? The reality is, if the index doesn't change, the ETF will not change, because the goal of the index ETF is to mimic the index. So unless there's a change in the S&P 500, that means amongst these 500 companies, S&P decide that, okay, some companies are going to go out of this index because it doesn't reflect the stock market, doesn't reflect the economy, and other companies are going to come in. Or in the STI, Straits Times Index, they're going to change up some of the companies, then these index ETFs will need to do their switches. But more often than not, these things don't really change. They do from time to time when whoever that's behind the index decide to reevaluate the index. But it's not like every day they are changing, or every week they are changing. It doesn't work that way. So if the index doesn't change, the index ETF doesn't need to do much work. So I will personally will not pay someone to not do much lah. And we need to understand that fees do play a big part in the way we invest, right? Which is why I'm super big on like finding a good, decent brokerage without much fees. And I'm not fancy of paying a lot of people a lot of fees if they are not doing a lot of work, or they're not value adding to that service for me. So specifically in the case of index ETFs, because they're not doing a lot, the market benchmark, okay, the market rate, it's about 0.2 to 0.4%. Anything more, you really got to question why the ETF is charging you so much. Right, so the average is about 0.2 to 0.4. Let's take that as the benchmark. Okay, so when you are choosing an index ETF, whether is it the SPY, whether is it the IWO or IVO, or is it ES3, all these are tickers. So I'm sure you come across some of these stickers when you just simply go and Google index ETF, like whole list come out. So all these stickers, they come out, and I will not go into them, individually. But you definitely want to make sure that it's within 0.2 to 0.4, because that's kind of the market rate. And most of the big index ETFs, right, are around this rate one. So don't need to be too worried, right? Which brings me to point number 2. So point number 2 is really about the tracking difference between the index and the index ETF. Because the reality is you're trying to buy the market, right? You're trying to get exposure to the market. You're trying to buy the index. But you cannot buy all this, so you buy the index ETF. The index ETF's role is to track the market. That means if the market goes up by 10%, let's say Straits Times goes up by 10%, which is very rare, and we can talk about why the Singapore stock market doesn't grow another time. Taking that as an example, let's say Straits Times goes up by 10% and your index ETF goes up by 9%. Then that will mean that there will be a 1% tracking difference, and that is huge, because 10 to 9, right, there's actually a 10% variance, right? To me, it's not acceptable, right? So we got to realize that there will always be a difference, or as expected to have a difference. But the question is, what is the optimal difference, right? The optimal difference is essentially the fee price. So when they say they charge you a fee, right, they're not going to actively send you like a bill and tell you, okay, you need to pay how much. No, it's just a reflection of the difference, right? Which means if they are charging you 0.3% for a fee, and this year's growth rate is 10% on the index, then you're expecting your index ETF to go up by 9.7%, factoring that 0.3%, right? So that is the optimal case, which is why I say when the tracking difference between the index and the ETF is optimal, is when it meets the cost, right? The low cost that we are looking at. Sometimes on very, very good indexes or very, very good funds, they do have times where the index ETF ends up paying more than the index. And this is because sometimes these index ETF guys, the fund managers behind these ETFs, they do take the shares that is owned by the ETF and lend it to someone else so that they can short the market and they can do whatever that they want to do. All those are technicals. But what I'm trying to tell you is that you must adjust your expectation. Or it's like you go makan somewhere and then the person give you extra dessert. Please don't expect that the dessert is included in the set meal. Okay, so the understanding is, as long as the tracking difference is small, which means optimal at the fee price, which is the low fees, that is good enough. It's very easy to calculate. Some platforms even have already calculated that for you, like etfdb.com. You can check them out. Or in Singapore's context, I think a lot of people use fundsupermart.com. You can check them out also. But Fund Supermart doesn't count for you. You might need to do a little bit of counting for yourself. So very simple. You just go and, if let's say you want to track STI, Straits Times Index, you just go and put STI under Google, Straits Times Index, and see the 1 year mark, right? What is the 1 year difference? And then you click on the fund, which I think ES3 is one of the more common fund that is tracking the STI index, and just kind of see that the differences. So you just kind of calculate yearly basis. Don't try to calculate day to day. So that will be kind of where it is. It's not that difficult, very easy to find. Do a little bit of calculation, okay? Take out the calculator app in your iPhone that you never use ever, right? Just do a little bit of calculation. It shouldn't be that difficult. Which brings me to point number 3. The third point as to what you should look out for when investing in an index ETF is you want to go for the big funds. You want to go for the big index. Honestly, I don't think there are a lot of small index ETFs also, but it's a good thing to understand why you want to go for the big index ETF. And Investopedia actually has a benchmark saying that 10 million and above fund size is considered good enough, right? So if you are going for the super big ones, of course they will be like in the billions. There's no big issue on that. But why we want to go for the big funds is because we want to go for liquidity. We need to understand that when we're investing, it is a lot about buy and sell. It's a lot about liquidity, because it's very easy to buy, but then when you want to sell it, who is going to take over? So in a big fund, it is much easier for money to come out because they have more money sitting around and people are very willing to take over from you, which is why ETFs are so amazing in what they do. A little bit different from let's say like property, right? You want to sell property and you got to wait for a buyer and you got to search for the buyer. You pay all the people in between to go help you source for the buyers. But the beauty about like stocks, let's say stocks per se, super liquid because there's an exchange and there are a lot of people that are looking to buy and sell. So the moment you go in, you want to sell something, people are willing to buy at a certain price, right? And for ETFs, you want to definitely look at those big ETFs, right? Which has the liquid asset to allow you to sell if you really need. All right, but I'm definitely sure that if you're looking at index investing, you are looking for the long term. Long term investing, right? We are not buying and selling a lot, but we just want to make sure that if we are going to any index and then any index ETF, we want to make sure that the ETF has the capacity to allow us to liquidate if we need. So I'm going to sum up these 3 pointers to look out for when investing in an index ETF. The number 1 is definitely you want to go for the low fees. Honestly, they're not doing much, so you don't want to be paying them a lot because it eats into your revenue, eats into your profits. And number 2, you want to go for the tracking difference, very optimal tracking difference between the index and the index ETF, which should match your fees. And number 3, you want to go for the big funds. Okay? Don't be a hipster. Don't try to go cafe hopping on the stock market or in the index market, right? Stick to the big guys, and I think you should be doing pretty well this period. So no more FOMO for you. Consider some index ETFs. And I hope you learned something useful today. See ya! Hey, I hope you learned something useful today and truly appreciate that you took time off to better your life with the Financial Coconut. Knowledge is that much more powerful and interesting when shared, debated, and discussed. Join our community Telegram group, follow us on our socials, sign up for our weekly newsletter. Everything is in the description below. And if you love us and want to help us grow, definitely share the podcast with your friends and on your socials. Also, sign up for our members backend for more investment-related content, live discussions, curated content, and most importantly, your commitment to us is a step forward for us to continue creating great content focused on you rather than advertisers. For more information, check out thefinancialcoconut.com. With that, have a great day ahead, stay tuned next week, and always remember, personal finance can be chill, clear, and sustainable for all. Okay, thanks for tuning in and continuously tuning in, especially for a lot of you guys that have been listening to all our other content and you may be re-listening to this on the main feed again. So great stuff. If you have not heard all these other content, maybe because we have all these other feeds there, and we're trying to keep the feed lean so that it does not become too messy. And if you're particularly interested in property, particularly interested in entrepreneurship, particularly interested in any other topic, head to the specific feed. Okay, you can go to thefinancialcoconut.com for more information. But I'm going to take this time to give you some updates. So, what is going to happen going forward with TFC, right? So, TFC at this moment in time, we're doing a few things. Number one, we're prepping new seasonal content, right? So, Coconut Avenue is getting a season 2. Entrepreneurship is very likely getting a season 2. We're confirming some of these things, so stay tuned with us. But on TFC's main feed, what is going to happen is Andrew Jan, professional DJ, will be taking over Chills with TFC. Right? And I did an episode with him to hand over this whole thing for Thursday segments. So you're going to be hearing him very, very soon. We did a fun episode to transit over to him. So thank you for supporting the podcast so far. But in order to continue to grow the network and make it a serious, big content player, we'll need to pass the mic, right? So Andrew's going to take over and I'll be freeing my capacity to do other things in our content network. So yes, all that jazz, pretty good. He is a professional. He's been doing this for years, doing DJ hosting, right? So it's going to be fun with him. He has the same vibe, similar vibes as me, also xiao, a bit of dad jokes here and there. So great, right? You will continue to be hosted well with him on Chills with TFC and all these new content that we're doing. We're also contemplating on doing YouTube in terms of adding a video element to some of these things because we do believe that some episodes recorded on YouTube can be pretty interesting too, right? So if you like it and if you think that we should do YouTube, please go to our YouTube channel now, The Financial Coconut, to give us a follow and let us know that, hey, I actually want you guys to do YouTube on certain content and we'll explore that for all of you also. So going forward, we're doing all these interesting new content, but everything still anchors around living life, at least like living the life you love while managing your finances well. Wow, so long that I record, I forget that the tagline. So yes, living the life you love while managing your finances well. And there are all these different aspects about personal finance and extension into careers, investing, entrepreneurship and all that jazz. So if there's any particular thing that you're looking for, please drop us hello@thefinancialcoconut.com. Sign up to be a member, to be on our members backend, and also, just hang around, join our Telegram group, and continue to help us grow. Yeah, stay awesome. Let us know. I want to see you soon. All right, so see you after my break lah. I'm gonna take a break. Meanwhile, take care.